Good afternoon, everyone. Thank you so much for being here. And I'd like to thank the panelists for joining us. So we now talk about tokenization and how, in particular, tokenization can become a powerful tool to unlock financing for small and medium, small and medium enterprises. So let me start with the core problem. So in many emerging markets, MSMEs, they face a structural challenge in that access to capital is expensive, it's concentrated, and it's intermediated by multiple layers, banks, securitizers, custodians, registers. So at the end, for many small businesses, this results in high funding costs, including working capital. There is limited investor reach. They have a hard time to find retail investors. And the processes are slow and bureaucratic. So tokenization has the potential of being a new way to rethink the entire stack and, in a sense, to cut intermediaries and to streamline processes. So the aim of this panel is precisely to reflect on the past, on the challenges that current infrastructures pose to financing MSMEs, and to articulate how this tokenized future will look like. So we are very lucky to have such a distinguished group of panelists who are leaders in the industry and also in policy. So I'm sure we have a very up-to-date perspective on the topic. So I'd like to say my personal hello to Stéphanie, to Michael, to Sandy, and to Carlos, who's joining us from Brasilia. So let me start with Michael. So Michael, Accion has long focused on expanding inclusive finance through digital tokenization and catalytic capital. So from your point of view, what's the central challenge facing underserved MSMEs today, and where does blockchain can help?
So excited to be here, part of this conversation. Accion is a global nonprofit dedicated to creating a more inclusive world. We're an investor, an advisor, and we try to influence policy. Over our history, we've helped to build about 300 financial service providers in 77 countries that are today reaching hundreds of millions of people who are left out. We work with financial institutions and fintechs, but ultimately we're working with micro and small merchants. And the core challenge is, frankly, just how to see them and how to serve them. And if you think of, Sophie had a framework this morning that talked about microfinance, digital financial inclusion, and now this is the third wave. And you can think of that as changes in technology, but you can also think of that in terms of changes in data. You know, going from old school microfinance of group lending where the group was the source of information, and then we moved on to individual lending and cash flow analysis, and then digital financial services with mobile phone data and all sorts of alternative data of utilities and education payments. And really, but all of that was still in the physical world. And what the third era is really about is entering a purely an original digitized world, which ultimately that whole path is all about seeing these companies and being able to serve them and reducing the costs. So I'm very bullish that tokenization, blockchain, stablecoins in particular can help us really do all of that much more efficiently. I think it's very, very early days, and I think we have to all work hard to figure out how to use these tools and use these tools responsibly. Tokenization, there was an earlier panel on tokenization of money and stable coins, and again, I think it's early and there are particular uses, specifically cross-border transactions and places with high inflation. In fact, I think stable coins are less relevant in a place like Brazil where you have PIX. So I think they're complementary. I think we're a big advocate of digital public infrastructure globally, but there are going to be places where there's still volatile currencies and don't have the functional government of Brazil or India. And then there's tokenization of assets, which is pretty new and very exciting. My favorite example is tokenizing livestock. There's a company in India that is, just like there's biometric IDs, there's biometric IDs for cow muzzles, there's muzzle IDs. And if you think about this, it takes a cow from being a commodity to being collateral. Because all of a sudden you can identify the specific cow. They even have a e-cow registry, and you can know your cow. And what this does is this really allows you to, it becomes an asset, and you can tell the difference between a cow in its early stage and a cow much later in life, and it's the health, and you can actually unlock lending against that asset. So there's again, this is brand new, innovative, but companies are actually doing this. But I think there's a lot of great potential here. I'll stop there.
Thank you so much, Michael. That's super interesting, and I like the idea that we're actually moving to a new era of new data, right? And new forms to generate data, and how that can complement existing products in the financial system and unlock new things. So I'd like now to hear Sandy, who I'm sure can provide another angle to this issue. So Sandy, small and mid-sized business, as we've been discussing here, they are a vital economic engine of the world's economy, especially in developing nations. And yet, they do not have easy access to the capital they need to grow. So what is C2FO doing to solve that, and how you see blockchain and tokenization accelerating your actions?
Yeah, I'll be pretty brief. The nature of C2FO is a proprietary ledger. So we match 2.5 trillion of accounts payable with 2.5 trillion of accounts receivable around the world. Our customers are the largest businesses in the world and their supply chains. So there are about 1 million businesses in that ecosystem. It's not very hard now with that data, and we've talked a lot about the value of data on these proprietary platforms. It's not very hard for us to make that a decentralized ledger. So today we run it as a prop ledger. Tomorrow, maybe even a little sooner than that, we are actually today now taking that off the central ledger, putting on a DLT, and making that data available for anyone who wants to finance those assets.
I see. That's very clear, very concise. So I believe it's really great what C2FO is doing and the impact it can have. So I'd like perhaps to change continent and hear Stéphanie on what Société Générale Forge is doing in France. So we know that Société Générale Forge has been working on the frontier of tokenized bonds and interoperability with existing market infrastructures. So from that experience, which tokenization use cases are the most realistic for improving MSMEs' access to finance in the near term, and which are still overhyped? We know a lot about use cases, right? And it's hard to distinguish which are the good ones.
Sure. We have quite an experience on tokenization because we are at Société Générale Forge, a subsidiary of the bank Société Générale, created 6 years ago to explore the new possibilities offered by blockchain onto the banking industry. And we started our activities by tokenizing bonds initially because it's easier. And so we were the leaders in 2019, 20, 21 in bond issuance in France and in Europe. We issued the first bond on a public blockchain in 2019 on Ethereum. We helped the European Investment Bank to do its first bond issuance on blockchain. It was a 100 million bond issuance. We issued the first structured product on blockchain, the first green bond on blockchain. So we have an extensive experience. The problem with this experience is that if you have only the securities leg issued on blockchain and not the cash leg, you cannot benefit from the productivity gains of blockchain. So for SMEs, what is absolutely crucial, and for anybody in the financial industry, is to move the infrastructure from the legacy financial infrastructure in bank accounts, in traditional market infrastructure, to a new infrastructure layer, which is blockchain. And there are several steps in this path. The first step for us was tokenization. The second step was issuing a settlement asset on blockchain. And at that time, and still currently, the only money on chain that exists is stable coins. And so we issued stable coins. I think we are the only major banking entity in the world issuing stable coins. We are issuing a euro stablecoin, which is called the euro convertible, and the US dollar convertible. And we are the first to get the MiCA license to do this activity in a regulated way, which is obviously very important for banks. So all of this is part of a movement of global tokenization. The next step is to create the market to be able to exchange the tokenized securities with the tokenized cash. And currently, it doesn't exist for mainly regulatory blockers, because of regulatory blockers. All of this is evolving. In Europe, the regulation is adapting to enable financial market infrastructure to move on blockchain, and in the US as well, because there have been some announcements about big international markets, NYSE, NASDAQ, and DTCC, the custodian, who have been announcing that they are building this infrastructure layer. So everything is there. We have the tokenized securities, the tokenized cash, the markets are being built, and the impact on SMEs will be huge, because they will have access to these new platforms, access to capital that they didn't have before, and it will help also to make the capital circulate much more quicker than it is currently.
Thank you so much, Stéphanie. What you're telling me reminds of some businesses in Brazil, some platforms for tokenization. One is called Amfi, and they build funds with receivables, and they invite small SMEs to, let's say, to create these funds with their receivables. They create some type of subordination structure so that there is some skin in the game, and then they distribute tokenized quotas of these funds to retail investors. So the costs of entering the capital market for these firms, they were prohibitive, but now they can do something. But one thing that's missing in this business is that's something that you mentioned that's very important, is that settlement and all financial flows happen in the blockchain, right? Because otherwise you are essentially changing the registration technology and the distribution technology. But if the financial flows are there, the gains are limited, right? The efficiency gains are limited. So I think it's really first order that Société Générale Forge is going all the way to unlock these possibilities. When it's not the case that you have settlement in the platform, you need to deal with interoperability, usually with legacy systems, right? And when we talk about interoperability, it's very important to recall the role of regulators. They are really essential to create standards and to steer the market smoothly towards these new technologies. So I think it's a good opportunity to hear Carlos on this respect. So Carlos, Brazil has become a benchmark for digital public infrastructures and for experimentation with tokenized financial markets. So from a financial authority perspective, where do you see the strongest use case for tokenization in MSMEs finance?
Okay. Hi, hello, Renato. It's a pleasure to be with you again on your side. And I'm very happy with the discussion. And I think that I could start with maybe the most practical point. That's from a financial authority perspective, the strongest use cases are very basic. You must combine clear economic value with real reductions in frictions. In that sense, what does it mean? It's very basic. It means that probably tokenized receivables and supply chain finance probably stand out as the most promising near-term use case for micro, small, and medium entrepreneurs. At least that's in an emerging market context, such as Brazil. Because receivables are already a core asset for many small firms. But they are often underused because you have fragmentation, operational frictions, fraud risks, legal uncertainty, and also limited transparency. This is a role where a tokenized environment can support efficiently. efficiently, mainly because tokenized can help make these assets more standardized, more easily transferable, and more scalable as a basis for financing. When mainly recalling what Michael has said of this new era of data, when you combine this tokenized ecosystem with richer data, I'm saying about fast payments, open finance, it can improve risk assessment and broaden the pool of potential funders. So you can improve the benefits of tokenizations. And Brazil also offers an interesting practical example here. Even before tokenization at scale, we have been building here in Brazil a centralized and interoperable ecosystem for electronic trade receivables, electronic invoice, so as we call here in Brazil, we call duplicatas. This is not a DLT-based arrangement, such as Sandy has mentioned. And that's his case, not a DLT-based arrangement. It's a regulated market infrastructure model with bookkeeping, registration, and centralized custody functions connect through interoperability rules. Nowadays we have 3 FMIs. It started in 2018 when we issued a law to have legal certainty on this digital representation and on digital pledge. And now we are launching this ecosystem in the third quarter of this year. And it's very interesting because this experience with invoices here already shows how this digital representation of receivables can reduce frictions, improve creditor confidence, and also have helped unlock credit. In that sense, tokenization should be seen as Stéphanie has mentioned, as a next layer that could optimize and expand this gain over time. So for MSMEs, the opportunity tokenization is quite concrete. Once working, you have faster access to liquidity, more funding options, and potentially lower financing costs. But again, from an emerging market context, and also as a regulator perspective, I still emphasize a pragmatic approach in the short term, because the strongest use cases are not necessarily the most sophisticated ones, but ones that solve some frictions, real frictions, using a very smart combination of new tools, new technology, and also the trusted existing infrastructure. So this is my view for this, Renato.
Thank you so much, Carlos. You know of my enthusiasm for your work. So, and I'm sure that the trend that you are mentioning can be seen in other jurisdictions, right? The smart combination of existing infrastructures with tokenization. That these are the low-hanging fruits that can be that we can reap at the moment. I'll turn to Michael. You were mentioning tokenization of assets and tokenization of even animals, right? So if you could explore a bit more how this process can unlock capital for MSMEs, and in particular how Accion is approaching investment decisions.
Again, all this is pretty early, but it's very exciting. Tokenizing livestock, tokenizing loan portfolios, tokenizing invoices. It's easy to imagine how this can really unlock assets. And also, we haven't really talked about fractionalization. You mentioned offering some of these products to retail investors. That can only be done in this new world where you can fractionalize everything. And again, we're just scratching the surface of it. As an investor, we're a very active investor in early stage companies, and we're pretty excited about new technologies that can lower the costs and make it easier to serve these micro and small merchants. So this is an area we're very focused on. First and foremost, I think the biggest application is cross-border payments. It is so expensive in the traditional correspondent banking world to move money, and in the new world order with stablecoins, you can do it fast, easy, and cheap. And that is so valuable to a company that is just beginning to work cross-border. So that's a whole area that we're interested in investing in. Wallets, USD wallets in a volatile market. I mean, you don't have to think about, Venezuela. You can think about Nigeria. Any country that has, double-digit inflation, you're going to see people who are attracted to a stable coin. And so we think that's a very investable place that can really, again, help small businesses, help micro and small businesses. Also, infrastructure and orchestration, right? There's a whole new world of how do you help small businesses to accept stablecoin in a compliant way. That's a new business that's also investable. And the last one, and this, again, it's all still early, is programmable micropayments. We're seeing some companies that are focused on that, and you can imagine the circumstance. So programmable micropayments in an insurance, we're here in Accion, in an insurance context that immediately pay out once a certain rainfall, a flood happens or something like that. And all of this is new technology that requires you to build trust. And I think trust is very fragile. And mostly we focus on people not trust. There's also a whole area of frauds and scams. I think there was a separate panel on that, because the same technology is facilitating frauds and scams too. But you can also imagine instant payouts on insurance claims actually breeding trust. If you all of a sudden get paid out real fast in real time, you're going to say, wow, that's amazing, and that's doable. So there's several nascent investable theses here.
I see. No, that's fantastic. I think the potential of stable coins for cross-border payments is something huge, right? Precisely because the infrastructure is by design cross-border, right? So you don't get all the frictions. But all we've been discussing, I believe, represents a tectonic shift to the banking industry, right? Because, in a sense, the small firms, they will be able to enter capital markets without this type of intermediaries, and so it's really a viable alternative for banks, and so there will be important changes. So I'll turn to Sandy. Sandy, you were CEO of a major regional bank in the United States. So how do you see tokenization and DeFi impacting banks generally?
Coming back to what we said earlier about accounts receivable being sort of difficult assets for banks generally, and why, in fact, since they are ephemeral and already somewhat digital, putting them on chain makes a ton of sense. So that's exactly where I think we'll see the markets go. The key will be, and this gets to the bank question, the key will be not just the chain's ability to lock down that asset and to avoid fraud and duplication, et cetera. The key will be our ability, using some degree of data, and in fact, a lot of data, to match that account receivable to the corresponding account payable. Because account receivable doesn't have any value at all. It's ephemeral, it's ethereal, it's a representation of what I think I'm going to be paid by my customer. Right? In the banking world, that was one of the sort of conceded constructs that we had when I was a banker. Accounts receivable have value. They have no value. They're only valuable if they're paid. So connecting the account payable to the account receivable and doing this in nationwide scale, like we're doing in Nigeria, soon in Kenya, South Africa, what we've done in India with the Treads platform, which we helped start, those are really interesting aspects that I think will actually be very difficult for the banks to overcome. Now, the banks are going to have to participate. The banks are going to be funders of these assets, but they're going to fund these assets with a lot less margin and a lot more benefit to the end user, not because the banks are necessarily bad. I come from 5 generations of banking. Now, my brother still runs the bank that's in the family. It's a $100 billion bank in the United States. It's a good regional bank. But our markups are ridiculous, right? I mean, what is the markup in a bank? It's our net interest margin. What's the net interest margin for the entire banking industry? That's exactly what we're attacking with DLT. Yeah. As we put these assets on chain, now it's going to be fine. The banks are going to have to become more efficient. Banks will exist. Bankers will exist, so don't get worried. I know there's a lot of bankers in the room. I'm one of them. I had hair when I ran my bank. That's how hard the banking business is. But this is going to create huge opportunities for small business. One, because we're going to create matches using data that de-risk the provisioning of capital. That's number one. De-risking the provisioning of capital creates a derivative impact, which is what? More capital and also lower price. We do about $1 billion a day of funding around the world in 120, 130 countries every day. That $1 billion globally is priced at a clear rate to that small and mid-sized business at around 7.9% APR, because we've de-risked by matching to the AP. Do that at national scale, do that at global scale, you can actually create another 6 to 7 trillion of GDP for the world. Because the numbers you heard today from Sophie are right, but they're low. The actual lack of funding for small and mid-sized business, and we know, because we see 10% of the GDP in the United States on our platform, we see XYZ% of the GDP on India. The funding that's not available for SMEs, the gap is actually about twice what Sophie said. It's between 8 and 10 trillion. And if you solve that funding gap, the amount of GDP is just phenomenal that we can create for those small businesses, which, as you all know, are 50 to 60% of the world's GDP. And yet, the number one impediment they have to growth is access to capital.
Well, thank you so much. That resonates, I believe, very much the Brazilian experience that Carlos mentioned as well. So the digital public infrastructure he was mentioning about invoices is replacing an old system where essentially you could only advance the invoice or negotiate your invoice with the incumbent bank that's actually issuing the payment method, the QR code-based way of paying the invoice. So it's amazing how market power can shrink the market and have implications, even macroeconomic implications, right? So that's fascinating. Let me turn to Stéphanie, whose blockchain platform is actually part of a large banking conglomerate, as you mentioned. So, Stéphanie, a recurring promise of tokenization is precisely this lower issuance and transaction costs. But in practice, what needs to happen for those efficiencies to be passed through to smaller firms rather than benefit only wholesale or institutional markets?
There are two ways of tokenizing. Either the banking industry will adapt this technology and give these benefits to MSMEs, either these MSMEs will go through digital, native, new platforms that will create all these benefits. All this fight is currently happening. So these new platforms, which are mainly crypto platform, I always say that the crypto ecosystem, the crypto markets are like a R&D lab for the future of finance. Everything is happening here, innovation, new ways of operating, breakthrough inventions, etc. And they will spread into normal capital markets. And the question is, will all these innovations be integrated in the banking and traditional financial industry to make the activities more efficient, have more productivity, and bring all this innovation to lower the cost of capital? Or will they be disrupted by new players, new platforms that are able to integrate this new technology? Currently, we don't know. Both are advancing. So as you may see, traditional FMIs are integrating blockchain. I spoke about the DTCC initiative, NYSE, NASDAQ. The DTCC initiative is very strong, is to be able, and the service will go live in September, for big companies to issue their shares and bonds either in traditional DTCC account or in blockchain, and they can choose which blockchain they want to have. So it's really a major evolution. And we'll see if this is open also to MSMEs. So for me, the biggest blocker is this transition for legacy capital market infrastructures to new ones, and how this innovation is integrated progressively in this field.
I see. That's really fascinating. I think one of the promises of tokenization is precisely to develop secondary markets and to allow for fractionalization, right? So that will certainly eat the margins of wholesale and institutional investors.
Maybe another topic, thinking about what you said, is also the development of DeFi for having access to more capital, which is always the problem of MSMEs. DeFi protocols, so decentralized finance protocols, will be able to make the match between people who have assets, who have liquidities, who have stablecoin, who have money, they want to lend, to companies who want to borrow it. And all of this tomorrow can be done on a peer-to-peer basis, which is currently not the case. Everything is intermediated through banks, etc. And so the direct access to capital on a peer-to-peer basis, for me, it's a huge transformation and will open new opportunities for small businesses as well as for wholesale businesses as well.
I see. That's fantastic. So here in the panel, I think the idea was to essentially start with let's say, current practices, to see the limitations, right? To see the potential for tokenization, then move towards tokenization, describe exactly what it can do, assess the impact, for instance, on the banking industry, and in a sense, have a quick look on what this new world can look like. But the flip side of the coin is precisely the risks that this new technology can generate, right? So we may now explore a bit these risks, and there's no one better than a regulator to think about risks, right? So I'll turn again to Carlos. How do you see the main risks that authorities need to manage as tokenized assets and new forms of collateral or credit intermediation grow, particularly around consumer protection, market integrity, operational resilience, and regulatory arbitrage? Carlos.
Okay, Renato, thank you. It's a very interesting question because depending on the regulator you're talking with, there are different risks. And as you mentioned, regulators, they really appreciate to talk about risks. And for following your question, maybe for didactic purpose, I can group these risks into those 4 areas that you have mentioned, and mainly because they are very closely connected. The first one you have mentioned, consumer protection and transparency. We must be aware that as these structures, they become more complex and even more automated with smart contracts, there is a real risk that smaller firms, the micro firms, they may not fully understand the terms, the risks, and even the responsibilities embedded on these arrangements. And we have this experience in Brazil with some credit card receivables. Generally, very small firms, they really don't understand if they really need that credit or if they're only taking that credit because it's easy. And sometimes we understand the small firms, they are even not assessing the costs of this credit. So again, having clarity, disclosure, suitability, and also accountability remain essential. The second group of risks is regarding marketing integrity and also market structure. It is very tricky because tokenization, as we've been discussing here at this panel, and I believe so, really can reduce barriers. But it also can create new forms of concentration. And authorities, they really need to avoid a scenario where markets become so fragmented across non-interoperable platforms, for example, or even if you think in another extreme, you may have to have so overly concentrated marketing, few larger players controlling access, data, and also distribution. That's why, in my opinion, taking my experience in Brazil, using digital public infrastructure as a level play field really supports a tokenized environment to develop in a very efficient way, avoiding this fragmentation or even avoiding this kind of monopoly effect. Third is very important, operational resilience. We are talking about increasingly technology-dependent infrastructure and often involving smart contracts, distributed environments, and also these new operational dependencies. And again, this raises questions about cybersecurity, governance, then the smart contract governance, the code governance, the system reliability, and how all these together behave under stress. And finally, the last block of risks I would mention, of course, as a regulator, the regulatory arbitrage. Because you have new forms of credit intermediation that could emerge outside the traditional perimeter, even when they perform functions that are very economically similar to the regulated ones. So authorities really need to enter to make sure that similar risks are treated consistently. So in many ways, as Renato may recall from our discussions here in Brazil, we generally say that it is not about entirely new risks that technologies bring. It's just about familiar risks, but taking new forms, often amplified by speed, complexity, and also interconnectors. So that is Renato.
Thank you so much, Carlos. That's super comprehensive. That's a great intervention. So I think it's very useful to contrast the public sector perception of risks with the private sector perception of risks. So I would like to turn to Michael to see what risks do you need to identify and address as this technology continues to reshape the financial system, in your opinion?
So this particular panel is a little Brazil heavy, and that's fantastic because I do think Brazil is truly among the leaders and among the strongest regulators in the world. I do worry a lot about the next level of regulators who don't have the resources and knowledge to regulate these areas that are so coming up. So think of the typical regulator who's stretched very, very thin. Barely able to keep up with current technology, much less able to keep up with brand new technology. So I worry a lot about that. The second thing is, if you think about crypto's now been around for a while, Bitcoin's been around for a while, stable coins have been around for a while, but why is this all happening now? A lot of it is the Genius Act and MiCA and new regulation, and we went from crypto being not collateralized and not regulated, and therefore largely inappropriate for the base of the pyramid in emerging markets. But all of a sudden, when it's collateralized and regulated, it can be a real tool that can lower costs. But here's the thing. So today, the two largest issuers are Tether and Circle. 2/3 of the stable coins that are out there are Tether. Tether is El Salvador-based. Not known, it's not Brazil. It's not known for its, and we were talking before, I know they are cleaning up their act, but the S&P lowered their rating on Tether because it was inadequately disclosed. That's 2/3 of the stable coins out there. I think Circle, by the way, is really trying to carve out its identity as being very compliant and very regulated and collateralized. So I think we all have to be a little more sophisticated in terms of how we. All stable coins are not the same, and those are just two because there's so many. Those are the two largest. Also, and this is a little bit broader than tokenization, but the enormous rise of frauds and scams, the same technology that is allowing us to better reach and serve people who we've never been able to reach and serve before, is also allowing, it's easier to defraud them. It used to be you had to go after people with assets. Now you can actually skim pennies from a lot of people through AI and take it. So there's a whole wave of frauds and scams. So there's a lot to worry about. But like any new technology, there's great potential and some downsides, and we have to manage our way through the downsides to unlock that potential.
I see. Thank you so much, Michael. I would like to add one risk that I perceive in this market as well, which is multi-issuer stable coins, right? If the same stable coin is issued, for instance, in the US and in Europe, if there is a run, you cannot distinguish where it was issued. So essentially, people will run to where the reserves are, but then it's impossible to do, let's say, prudential foresight when essentially you don't know what you are managing. But let me turn to Stéphanie to keep researching the risks of this new technology. So what risks do you need to identify and address as this technology continues to reshape the financial system in your view?
The risks are not different than the ones in the traditional financial activities. They are roughly the same. Money laundering, cybersecurity, everything related to investor protection, etc. And so all these risks are already tackled in the MiCA regulation. I personally contributed to draft the MiCA. I drafted the French regulatory framework when I was in the French Markets Authority as Deputy General Counsel, and then I contributed to draft MiCA. It was already 3 or 4 years ago. So we took, all the risks of the traditional financial regulation and adapted them to blockchain. And so basically we cover everything. It's a regulation that is easily understandable because it's the same that we already know in finance, with small adaptations. So the real challenge now is the harmonization of the rules globally. Because we know that MiCA is really in the forefront of a regulation. I think it's the most advanced regulatory framework in the world. But now we need to have the same in the rest of the countries, and as much aligned as possible. So that's why we're advocating for equivalence regimes to make sure that we can operate in the same way as in traditional markets.
I see. That's a very important point, especially regarding regulatory arbitrages, right? So.
Exactly. We have the problem of regulatory arbitrage inside Europe. Outside, it's not totally the same, I don't think. There are some questions of alignment. For example, we are seeing, a Genius and MiCA regulation on stablecoins. There are some differences. For example, on the remuneration of stablecoins, there is a risk of level playing field if it's not the same. On multi-issuance, we need to see also what's happening. I agree with you that it's a concern to make sure that at any time there is the sufficient reserve in fiat money in each jurisdiction. In case of anything happens, the holders can be reimbursed. But the real added value of stablecoin is to have one asset with the possibility to be transferred all around the world. If we have one stablecoin for Europe, another one for the US, another one for Asia, etc., there's no point, there is no added value of stablecoin. So we need to imagine and to find a way to have one asset globally, but the reserve being split in different countries to make sure that there is sufficient reserves. And there are ways to do that.
Can I just add one point on regulatory arbitrage? As great as the Genius Act is in the US is, and I think it was a real advance, they've delegated enforcement to the states. It's very, very easy to imagine 50 states competing to the ground. And that hasn't happened yet, but it's very easy to see how you could have that kind of regulatory arbitrage. So it's another thing to worry about.
I see. Okay, so perhaps we could finish the panel on a happy note. So I'll turn to Sandy. You have any concluding thoughts on the future of tokenization, and in particular, how you see decentralized ledgers improving information flow for provisioning of capital to small and medium-sized enterprises?
Yeah, so two things very quickly. We have plus or minus 1 million MSMEs on the platform. They don't want necessarily to be precluded these opportunities because we in this room are regulating it overly so. They need access to capital. They want that access to the capital. They do not want to be slowed down by regulatory bureaucracy. So the one thing that I would leave us with, and I think it is a happy note, the happy note is, let's see if we can get things to be well regulated, but not perfectly regulated, because we're not going to get to perfect. There are too many businesses in this world right now who are starving for capital, not regulation. And those small businesses are the ones that are being harmed in many ways by our regulation. So I would leave that thought for you. And tokenization itself, as we said earlier, every bank, all good, all important economic engines to this world, is a proprietary ledger. Mm-hmm. Think about the duplicative costs of all of those proprietary ledgers. That's precisely what DLT is attacking. The ability for us to create a ubiquitous, durable, embedded, cross-nation platform that allows data and with really good data, in fact, as we were talking about matching AP to AR or muzzles to cows or whatever it is you want to say, really good data can solve tremendous problems in the financial system. And the financial system doesn't necessarily have the right incentive because it's that lack of clean data that allows them to get their margin. If we create more clean data, we attack the margin, but we also, more importantly, attack the quantity of flow. And as the margin comes down, it's not going to be the end of banks because your quantity of flow is going to go up. I mean, I'm old enough to remember $50 stock trades in the United States. Nobody pays $50 to trade a stock today. And yet all these firms did very well because the flows and the quantity exploded as the price went down. We'll see that also in traditional finance.
Yeah, as we enlarge the pie, even old actors can benefit, I guess, right? So I think that's a good happy ending for us, right? So we are on time as well. So I'd like to thank very much the panelists, Carlos, Sandy, Stéphanie, Michael. Thank you so much.
Thank you.